Let's talk about the concept of an initial public offering, or an IPO. Now, an initial public offering is the case where a privately held company decides that it's ready to be a publicly held company. That is, that it will sell shares to the public so that people can buy shares in the company. Okay? For a long time, Facebook was a privately held company, so Mark Zuckerberg had a lot of shares. Other private investors had invested in the business, but the average person couldn't own shares in Facebook. And then they had an initial public offering, and now anybody can buy shares of Facebook. Okay, you can, if you have a brokerage account, or you can open a brokerage account online or with one of the brokerage houses, and buy shares of Facebook now. So you can be an owner in Facebook. Now, what are some of the reasons that firms choose to go public? Well, one is it allows them to raise significant sums of capital. If you're only trying to raise $50,000, $100,000, maybe even several $100,000, you may be able to finance that yourself through the equity in your home, through your savings, maybe through some investments in friends and family. If you're trying to raise a bit more than that, if you're not incredibly wealthy and don't have wealthy friends, you may then need to go to a bank, but banks are generally hesitant to lend to startup companies. But you may be able to find an angel investor or a venture capital firm that will invest in your business. So here you might be raising, $1 million or $2 million. But if you get to the point where you need to raise hundreds of millions, okay, maybe even $1 billion or more, then it's very hard to raise that through venture capitalists or angel investors. Here's where you decide to go and have an initial public offering. So you can raise a lot of money that way. It tends to increase the firm's visibility. Most of the firms you're familiar with are public companies, okay? Microsoft, Apple, Ford, etc. Okay, Procter & Gamble. These are public companies, and you can buy shares and own shares in the company. You can be an owner, essentially. Okay, one of the nice things about becoming a public company is it allows the owners, okay, Mark Zuckerberg, for example, in the case of Facebook, the venture capitalists, the employees, to cash out some of their stake. Okay, Facebook may have been worth, billions of dollars. Zuckerberg may have been worth billions of dollars, but when it was a privately held company, it was a lot harder for Mr. Zuckerberg to spend some of that money. Okay, in the case now, he has a lot of shares of Facebook. If he wants to spend it on a house, donate it to charity. In fact, he made a commitment to the city of Newark, New Jersey, to fund education reform for $100 million. Okay, now he has these shares. He can simply sell the shares or donate the shares to some charity. But when it's a privately held company, he can say, "Look, I'm worth $9 billion," but how does he sell those shares? Okay, it's a lot harder when you're a privately held company. It's also nice to be a public company because it provides the company currency for acquisitions. You'll find a lot of smaller or a lot of new companies will try and grow, especially in the tech industry, by buying other companies. Okay, Facebook may buy a company that has some game or some technology that will fit rather nicely with their business. So rather than create their own game, they may just buy the company, and they may do that through a stock acquisition. All right, well, a little bit of a comparison of the two. A public company is owned by shareholders and institutional investors, most of whom have nothing to do with running the company. Okay, look, Facebook is now a public company, and Mr. Zuckerberg runs the company, and he owns a lot of shares. But, many of the people who have invested in the business do not have any real stake in running the business. They can vote for board of directors and things like that. I mean, if you own some shares of Microsoft or Apple, you don't run the company. You get the opportunity to vote for some things like auditors and board of directors, but you don't actually run the company. There may be some large investors who sit on the board of directors, but again, most of the shareholders have nothing to do with running the business. In the case of a private company, the private company may be owned by an individual, for example, Frank's Barbershop, or Frank owns the business and also runs the business, okay? Or he may have gotten some money from friends and family who have invested in the business, and some of them may not have any stake in running the business, but some may. Some may be participating in managing the business, okay? A company may have gotten some money from venture capitalists. Now, they don't just give you their money. They're going to sit on the board of directors. They're going to help you pick a management team. They're going to be actively involved in running the company. If you have a public company, there's a lot of disclosure that's required by law. You may have heard of the Sarbanes-Oxley Act, which came out sometime after the Enron debacle. And this requires a lot of disclosure from corporations. Okay, they have to report certain things, and even before Sarbanes-Oxley, you still had to file things with the SEC. You had to have audited financial statements. There's a lot of information that's publicly available. Okay, you can find out how much the CEO makes, etc. In the case of a private company, there's very little disclosure. Okay, Frank's Barbershop, you don't know what Frank makes unless Frank wants to tell you. He can own 4 or 5 barbershops, but if he owns the business himself, he'll file his tax return, he'll report his income, but it's not reported anywhere. You can't go to a website where it says, Frank got paid $1.2 million for his barbershop empire. Okay, none of that information is made available. That may also be the case with technology or other things they're working on. Again, when you're a public company, shareholders have a right to know what you're up to. When you're a private company, it's nobody's business. In the case of a public company, it's easy to trade the securities. Okay? You can buy Microsoft and a minute later sell Microsoft. Okay? When you're a privately held company, it's much harder to sell your stake or to buy a stake in the company. And you don't actually know what those stakes are worth because there's no quote anywhere. When does a company choose to go public? Well, it should have established its business enough that average investors would be interested in investing in the business. That is, that there's a risk they can evaluate. They know it's a young company and they know it's risky, but they understand what the company does. Now, we've gone through times during the internet boom back in the late 90s when companies that had no business model went public. But in general, people won't invest in a business unless they see that you actually do something. Okay, you're a sandwich shop like Subway, and you actually have 10 stores opened, and you're planning to open more, and people understand what it is you're doing. Private companies, on the other hand, oftentimes are very risky, and it's hard to evaluate those risks. Okay, these are risks private investors may be willing to take. Okay, a venture capital firm, an angel investor may be willing to take the risk of a new tech company simply because they understand technology. But the average person on the street doesn't understand whether you're going to be able to build, a backpack that that jettisons you around, from place to place and make it cost effective, or an electric car, or a car that drives itself. Google and some other companies are working on that. Okay, technology people, a venture capital firm may be willing to take that risk, but the average person, average investor probably wouldn't. Okay, in order to go public, you have to have the infrastructure to deal with the reporting requirements. Okay, to deal with things like human resources, you have to have, a payroll set up. You have to have, a benefits office. You have to be able to take care of these kinds of things because you're going to have to report these things. And, again, a small business oftentimes has, literally the owner has his receipts in a shoebox. Now, most people are doing a little better than that using, some of these software programs to keep track of their receipts. But, if you go back a generation or so, that's what a small business did. Okay. What does this look like? Okay. Basically, the idea of an initial public offering, or actually any kind of offering of securities, is the firm decides to issue the new securities. So they go to an investment banker who agrees on the type and the price of the security. And what they do is they help the firm prepare the prospectus. And that prospectus goes to the SEC, who reviews it, and then they distribute it to their brokerage network. Okay, you're trying to find out who's interested in buying the security. So also go through something known as a road show in order to try and drum up interest for the offering. Okay, and these road shows now oftentimes they're available online, are for institutional investors, pension funds, mutual funds, etc., who will be buying the bulk of the shares. Okay, once the SEC approves and finalizes a prospectus, it's distributed, and then in this case the investment bank, okay, may buy, we call this underwriting, they'll buy the issue at a lower price and then they'll try and sell it to the public at a higher price. And then those proceeds will be sent back to the firm, so they'll have raised this capital, okay, or raised this money to expand their business. Now, in another video, I'll go into a little more detail about the offering process.